Hello, our project is predicting oil future prices. We are Group 36. I'm Jacob. Chase is here with me, and Tharoon is our other group member. Motivation for this project is that WTI crude oil is one of the most actively traded commodities. The prices of WTI crude oil influence global markets, economic policy, and investments, as well as industries like airlines and trucking. Price movements are impacted by a variety of things, including supply and demand, geopolitical events, and macroeconomic data. So, accurate forecasting is crucial for traders, investors, policymakers, and hedging in industry. And no team members have prior experience with this project, so we all started out fresh here. So, our problem statement is to build a model to predict the next month WTI crude oil future price on a daily basis. Traditional models like linear regression or REMA often fail to capture nonlinear, time-dependent patterns in time series data, leading to poor predictions in oil future pricing. Neural networks, on the other hand, particularly along short-term memory or LSTM models, have demonstrated superior performance in handling sequential dependencies that occur in data like crude oil future pricing. And we decided to take a multivariate LSTM approach to solve this problem. The data that we collected came from Bloomberg Terminal because all three of us are financial mathematics students here. So we figured we'd get some practice doing this like we would in industry. So we got the front month open price, the front month close price, the trading volume, and those are all daily data. And then we got the last known inventory in millions of barrels, which is weekly data. And we're aiming to predict the next day front month close price. As far as what we did with the data once we collected it from Bloomberg, for our daily returns, we took logs for normality and stationarity. And as far as feature engineering, we created a few extra features from the data we collected from Bloomberg, including the 5-day moving average, the 20-day moving average, 14-day RSI, or relative strength indicator, and a 14-day volatility.
Yeah, we can get into looking at the model itself. So here we have the different LSTM model parameters that we kind of did a grid search for cross-validation. Cross-validation was done on the time series starting from the beginning of 2020 through to the end of 2023, and we searched each combination of these values here for the look back window, which is how far back the model is using for each window when it's predicting a certain day. Hidden size for the layers, number of layers, and the dropout rate in between layers. And then there on the right-hand column, you can see the optimal values that we found during that cross-validation period. And then some other things. The loss function that we used was mean squared error. And one thing we did with the testing data, which is we tested on the year 2024, the full year. And what we did was we reset the model once a month. So it would train on each sequential data point after it. So it would make the prediction. And then once it got the true value afterwards, it would then train only on that one data point going forward through until the end of the month, which was 3 business days prior to the 25th of each month. These WTI contracts roll over to the next month, and there's low trading volume on those days. And so when we would reset the model and train it anew from the beginning of the training period 2020 through up to the current date. And then we would start that process again for the next month. So that contract rollover is the trigger that we would use to reset the model each month. We can go on to the next slide here. These are the results for 2024. We compared it with our baseline model, which was an Remax model. And that one was done, the differencing was done outside of the Remax procedure when we took the returns and fed them in. Other than that, it was a 407 model that we used for the Remax. We can see LSTM did better for mean absolute error, mean absolute percent error, and root mean squared error. And it also did better on directional accuracy. It's interesting to note that both of them did were directionally accurate less than 50% of the time. But it is also important to remember it was trained to minimize mean squared error or mean squared error. So it had a priority on being correct when there was a big price movement, rather than just focusing on being directionally correct. And we can go on to the next slide from here and kind of see what the result of that is. This is just a sample trading strategy, where it generates signals each day based on its prediction of which direction the price is going to move. We had a threshold where it had to predict that the price was going to move more than 1%, before it would trade. So that's why you do see some flat lines there in the blue plot. So the dashed green line there is the underlying, that's WTI prices. The blue line is our LSTM trading strategy, and the orange line is the Remax trading strategy. And we can see that even though it was directionally accurate less than 50% of the time, the LSTM model actually made money, and even compared to the underlying asset itself. So those are kind of the results for the sample trading strategy. I think that's all we got. Thank you.